Good evening. My name is Andre Elliott, Chairman of the Global Infrastructure and Projects Group at KPMG. Today I will be discussing the Basel III and its effect on infrastructure. The economic cost of the global financial crisis during the past 5 years has been shockingly large. Under the pre-crisis rules, banks were allowed to increase their leverage to unprecedented levels. This increased risk in the financial system, and when the crisis hit, it resulted in massive public bailouts around the globe. In response to the bailouts, the Basel Committee made a capital reform called Basel III, which raises capital requirements significantly from 2% to a mandatory hold of common equity capital of at least 7% of banks' risk-based assets. Banks claim that tougher capital standards will force them to put brakes on lending, which is already sluggish under the weight of a slumping global economic growth, and may further delay recovery. The implementation of Basel III will weigh on the ability of banks to provide project finance loans on which cash-strapped governments and developers of power plants, pipelines, and renewable energy rely to fund plans. If long-term lending requires more capital to back it, it affects the enthusiasm of banks to provide loans. In Europe, this will hamper efforts to attract private funds to transport, energy, and communication networks that are key to economic growth, as well as providing jobs at a time when many European countries are struggling with unemployment. Basel III is expected to be implemented sometime between 2013 to 2018. Bankers say the impact on project loans will be felt before the rules kick in, as banks compete to show investors they are positioned for a new capital requirement. Under Basel III, there is an expectation that the volume of project finance loans will drop very significantly over the upcoming years because finance loans will become scarcer due to the more expensive way they will be accounted for. Currently, the European Commission is exploring initiatives such as backing project bonds to compensate for any drop in project finance loans. The market for project bonds suffered after the woes of companies that issued bonds in the credit crisis of 2007. Some financiers see opportunity to create new instruments that can lift a project bond credit rating from a BBB range to a A category, attracting a wide pool of institutional investors. This market is still in the beginning, but it has the potential to fill the gap left by the Basel III hit on the project finance industry.